You know, there's a strange thing about Wall Street. Everybody wants to know what's coming next, but very few are willing to listen to what the market is already saying. The tape speaks louder than any man, but most traders don't have the patience to let it finish its sentence. And that's exactly what we're talking about today. How to predict major financial moves. If you remember the previous video on signs that a trend is about to begin, you'll see this is the next step in the same study. Back then, we talked about catching the spark. Today, it's about seeing the fire before the crowd smells the smoke. Now, let me tell you something I learned early on. The market doesn't hide its intentions. It whispers them softly through price action, through volume, through the behavior of men who are too sure they know better. You just have to learn the dialect. You ever look at a chart and feel like something's shifting beneath the surface, but you can't quite say what it is? That's your intuition talking. The part of your trading mind that's developed from thousands of hours of watching the market breathe. Never ignore it, but never trust it blindly either. The market demands proof, and it gives it in its own time. See, the major financial moves, the ones that make and break fortunes, they don't arrive out of thin air. They build slowly, like pressure under the earth. Prices consolidate, volume dries up, and the public grows bored. That's when the professionals are busy. They're quietly taking their positions while everyone else complains there's nothing happening. Then, when the move starts, the crowd rushes in late as usual. By the time they're convinced, the insiders are already selling to them. Doesn't that sound familiar? When I study a stock, I never ask myself why it should move. The why belongs to the newspapers. I look for when. Timing is everything in speculation. The man who buys right but too early is just as wrong as the one who buys late. So I watch for the market's telltale signs, the small but consistent clues that a big move is brewing. A narrow trading range after a long decline, for instance. That's often the market catching its breath before a turn. Or when a stock refuses to go down on bad news, that's strength, my friend. Quiet strength. You see, predicting a financial move isn't about fortune-telling. It's about pattern recognition. The human mind craves certainty, but the market only offers probability. So what do? We train ourselves to see recurring behaviors, the footprints of big money. When a move begins, it's not the small trader who creates it. It's the large operators, the ones with resources and patience. If you can learn to spot where they're moving in, you'll stop following the crowd and start following the leaders. Let me ask you, how many times have you bought because you felt the price was too low only to see it go even lower? Every trader has been there. The truth is, the market doesn't care about what feels cheap or expensive. It only cares about what's being accumulated or distributed. That's why you must learn to read the tape without emotion. Prices are never too high to buy, nor too low to sell. If the conditions are right, the market tells you what it wants to do. Your job is to obey, not argue. Now, remember in that earlier video about signs that a trend is about to begin, we talked about momentum shifts and the early tremors that hint at a breakout. What we're discussing today is how to connect those tremors into a map of probability, how to sense when a small ripple can become a tidal wave. Because predicting a major financial move is not about predicting direction alone. It's about understanding commitment. Are the big operators committed? Are they quietly building a campaign? The chart will show it if you know what to look for. When I traded in my early years, I used to think that I had to outsmart the market. I wanted to find secrets others couldn't see. But the truth is, the market's secrets are plain as day. They're just ignored because they seem too simple. Take volume, for instance. When a stock advances on strong volume, pauses, then continues with less resistance, That's confirmation. When it declines with light volume and suddenly spikes down with heavy selling, that's exhaustion. Each move, each hesitation, tells a part of the story. Are you reading it or just watching it happen? Every great move I've ever caught began long before the newspaper caught on. By the time the world is talking about it, the best part of the move is already done. The professional buys when the chart is quiet and sells when the crowd grows loud. That's human nature. Most men are only comfortable moving with the majority. But markets reward the minority that acts before the crowd sees the light. So the next time you feel the urge to jump in because everyone's talking about a can't-miss opportunity, pause, ask yourself, who's selling to me right now? There's another thing, and I want you to take this seriously. Predicting a move isn't just about the chart. It's also about your capital, your mindset, and your patience. A man can be right about the market and still lose money if he can't sit tight. The real skill isn't just finding the entry. It's holding your position through the noise. The market will test your nerve at every turn. Can you stay calm when prices wobble? Can you resist the urge to grab a small profit when a big one's still unfolding? Because in the end, the big money is not in the buying or the selling. It's in the waiting. You might think you need a 100 indicators or some secret algorithm to spot these moves. You don't. All you need is a clear eye and the discipline to watch without bias. The market paints a picture every day, but most traders are too busy arguing with it to see the image. Try listening instead. Watch how price reacts at key levels. Note the rhythm. Fast, slow, hesitant, decisive. That's the heartbeat of the market, and it never lies. Now here's something I've noticed after years of trading. Every major move begins with disbelief. The public refuses to believe the turn is real. They call it a temporary correction or a short-term rally. Only when the move is nearly done do they finally believe. And that's when the professionals quietly exit. It's almost poetic how predictable human behavior is. That's why studying market psychology is just as important as studying charts. The two are inseparable. A chart, after all, is just a picture of collective emotion over time. So when you think about predicting a major financial move, think less about predicting the future and more about interpreting the present. The future lives inside the present, just as the next move lives inside the current pattern. Learn to read those patterns like a detective reads clues, not like a gambler guesses odds. Every top, every bottom, every breakout. Each has a rhythm, a sequence, a build-up. Once you see it clearly, you'll realize the market's biggest moves are rarely surprises at all. Predicting moves is about probability, not certainty. That single idea separates the professional trader from the dreamer who gambles on hunches. The market never guarantees anything. And the moment you start believing it should, you've already lost. You see, too many people come to Wall Street looking for sure things. They want a formula, a magic combination that tells them what's going to happen tomorrow. But the market doesn't deal in guarantees. It deals in odds. Your job as a trader is to understand those odds and position yourself where they lean in your favor. Think about it like this. Every price movement is the sum of countless human decisions. Fear, greed, hope, hesitation, all mixed into a single quote. How could anyone ever be certain about what that collection of emotions will do next? But what you can do is recognize recurring behaviors. The market, for all its complexity, is built on the repetition of human psychology. Fear always looks the same on a chart, and so does greed. Once you've watched enough of it, you begin to see probabilities instead of predictions. You learn to say, this setup tends to produce this kind of outcome, instead of this is definitely going up. The amateur wants to be right. The professional wants to make money. That's the difference. I've seen countless traders destroy good positions because they couldn't accept uncertainty. They needed to know what was going to happen. And when the market didn't confirm their expectation immediately, they panicked. You can't force the market to validate your belief. All you can do is operate with the best information available and accept that even the best setups fail sometimes. A successful trader doesn't need to be right all the time, just right enough when the odds are in his favor. You ever notice how the crowd behaves after a major move? When prices start climbing steadily, the public gets more confident with every tick upward. They begin to believe the rise will never end. Then at the top, when the probabilities have turned, they still can't see it. They're blinded by certainty. That's what probability trading protects you from. It keeps you humble. You stop predicting. You start preparing. You don't marry your opinions. You date your trades. You're willing to be wrong because being wrong is part of the business. The market speaks in signals, not certainties. A breakout above resistance with strong volume is a signal, a suggestion that demand is stronger than supply, but it's not a promise. A reversal pattern at the bottom of a long decline hints that selling pressure might be exhausted. Again, not a guarantee. The man who understands probability treats these signals as evidence, not prophecy. He builds a case for action the way a detective builds a case for guilt, carefully with proof that can still be challenged. The moment you attach certainty to a trade, you attach emotion, and emotion clouds judgment. You start defending your position instead of analyzing it. That's when the market punishes you. Every great trader I've known accepts uncertainty as the price of admission. We don't control the outcome. We control our reaction. We control how much we risk, how we size our positions, and when we step aside. That's what probability-based thinking really means. It's not about predicting, it's about managing. Let me ask you something. When was the last time you took a trade knowing it might fail and still felt calm about it? That's the mental balance you need. Because if you've done your homework, if you've read the chart, understood the market context, and sized your risk properly, then a losing trade is just another statistic in the larger sample of your process. You're not shaken by it because you know no single trade defines your success. That's how professionals think. They trade the law of large numbers, not the outcome of one roll of the dice. When you shift your mindset from prediction to probability, you also free yourself from the constant emotional roller coaster of needing to be right. You begin to think like an investor in odds, not emotions. Each setup becomes a business proposition. If I take this trade 10 times under the same conditions, will it make money overall? That's how systems are built, how confidence is earned. It's not in calling the top or bottom. It's in consistently executing where the math favors you. Remember what we discussed back in the video about signs that a trend is about to begin. How the early signs don't confirm a trend, but they hint at one. That's the essence of probability thinking. You're not claiming to know. You're identifying a likely scenario and positioning yourself to benefit if it unfolds. That's what separates speculation from gambling. Gambling is guessing without evidence. Speculation is reasoning with uncertainty. In trading, the best you can ever do is stack probabilities in your favor. You might have a setup that works 60% of the time. That's not perfect. But with proper risk control, it's enough to build wealth over time. The trick is to keep your losses small when the 40% happens. A trader who understands probability doesn't chase perfection. He chases consistency. He accepts that losing is part of winning just as drawdowns are part of growth. Think about how a casino operates. It doesn't need to win every game. It just needs to maintain an edge, no matter how small, over a large number of plays. There's an interesting thing about the markets. Everyone wants to know what's coming next, yet very few are willing to pay attention to what the market is already communicating in the moment. The market is always broadcasting its message, but most traders don't stay aligned long enough to let that message become clear. And that's exactly what we're diving into today. How to recognize the psychological structure behind major financial moves. If you remember the previous video on signs that a trend is about to begin, this is simply the next layer. Back then, the focus was on spotting the first shift in the market's collective mindset. Today, we're stepping into understanding how a major shift develops long before most people recognize it. Now, there's something I learned early on. The market never hides what it's preparing to do. It expresses itself constantly through price, through volume, and through the behavior of traders who believe they know how the market should behave. Your job is to learn the language of the present moment. You ever look at a chart and sense something subtle is changing, but you can't fully articulate it? That's your internalized experience speaking, the intuitive part of your trading mind shaped by countless hours watching the market reveal itself. Never dismiss that intuition, but never let it override the evidence. The market confirms everything on its own schedule. Understand something. Major financial moves, the ones that truly shift accounts and create life-changing results, don't materialize instantly. They develop gradually as the collective beliefs of market participants evolve. Prices tighten, volume quiets, the crowd loses interest. That's when traders with clarity are active. They're positioning themselves while everyone else assumes nothing meaningful is happening. Then, when the move begins, the masses respond late, as they always do. By the time they accept the move as real, the traders who were aligned with the market's early signals are already taking profits into their certainty. You've seen this before, haven't you? When I study a market, I never ask why something should happen. The why belongs to people who believe the market needs to justify itself. I focus instead on when the conditions align. Timing is everything in a probabilistic environment. The trader who acts early out of fear or impatience is no different from the trader who acts late out of confirmation seeking. Both are operating from the same psychological flaw. So I watch for the market's subtle cues, the recurring behaviors that reflect a shift in collective conviction. A tight consolidation after a long decline often reflects a change in belief. A market refusing to drop on negative information reveals strength, not loud strength, but stable, objective strength. Predicting a financial move has nothing to do with certainty. It's about recognizing the patterns of behavior that repeat because human psychology repeats. The mind wants guarantees, but the market only offers probabilities. So what do? We train ourselves to recognize the footprints of large, confident participants, the ones whose actions shape market structure. When a move begins, it's not retail traders creating it. It's participants with size and emotional neutrality. Learn to spot their behavior, and you won't need to follow the crowd ever again. Let me ask you something. How many times have you bought because the price felt cheap, only to watch it go lower? Every trader has experienced that emotional trap. The truth is, the market doesn't respond to your feelings about value. It only reflects collective actions. accumulation, or distribution. That's why you must learn to read price action without projecting your beliefs onto it. Prices are never too high to continue, nor too low to decline further. If the conditions align, the market shows you its intent. Your job is to align with it, rather than impose your expectations on it. Remember in that earlier video when we talked about early signs of emerging trends? Today we're stitching those early clues into a broader psychological framework. We're learning how to gauge when a subtle tremor becomes a meaningful shift in belief. Predicting a major financial move isn't just direction. It's understanding whether the market's collective energy is committed. Are large players committed to a narrative? Are they gradually building conviction? The chart reveals all of this if you view it through the lens of probability instead of prediction. When I was a new trader, I used to believe I needed to outthink the market. I wanted hidden information others didn't have access to. But the reality is that the market's secrets are visible in every movement. Most traders just overlook them because they seem too straightforward. Take volume. When price moves higher on strong participation, pauses, then resumes with ease, that's alignment. When a decline weakens and then suddenly accelerates with emotional volume, that's exhaustion. Every movement is feedback from the collective psychology. Are you interpreting that feedback or merely watching charts flash by? Every major move I've ever recognized began long before the world acknowledged it. By the time the public embraces a narrative, the primary move is already fading. Professionals gain exposure during the quiet phase and exit into the crowd's excitement. That's because most people can only act when they feel validated by others. But the market rewards the trader who acts based on objective information long before the crowd develops certainty. So when you feel tempted to chase a popular narrative, pause. Ask yourself, who is taking the other side of my enthusiasm? And there's something else, something every trader must internalize. Recognizing a major move is not only about the chart. It's about your mental structure, your capital structure, and your emotional structure. A trader can interpret the market correctly, yet still lose because he cannot remain aligned during temporary fluctuations. The real skill isn't identifying the setup. It's maintaining psychological equilibrium after you're in it. The market will challenge your emotional stability repeatedly. Can you remain neutral when price wobbles? Can you resist the urge to secure a small gain when a much larger probabilistic edge is still unfolding? Because the greatest profits aren't in entry or exit. They're in the ability to let an edge express itself. Most traders believe they need endless indicators or sophisticated tools to spot major moves. You don't. You simply need a disciplined mind capable of perceiving what's actually happening. The market expresses a continuous stream of information, but most traders are so emotionally entangled they cannot perceive it objectively. Pay attention to how price responds at key levels. Notice the pace of movement. Quick, slow, hesitant, forceful. This is the market's emotional signature. And that emotional signature is more truthful than any opinion. Here's something I've observed through years of studying trader psychology. Every major move begins with disbelief. The public denies the validity of a new move because accepting it would force them to abandon their previous bias. Only when the move is nearly complete do they accept it as truth. And that's when professionals quietly exit. Human behavior is astonishingly predictable. That's why mastering market psychology is inseparable from mastering charts. Charts simply document emotional shifts over time. When you think about predicting a major move, think less about forecasting the future and more about observing the present with clarity. The future is embedded in the structure of the present. Each next move is concealed inside the current pattern of beliefs. Learn to interpret those patterns the way a skilled observer interprets human behavior, not as a gambler making guesses, but as an analyst recognizing recurring emotional dynamics. Every top, every bottom, every breakout develops through a sequence of shifting beliefs. Once you recognize this, major moves stop being surprises. Predicting moves is about probability, not certainty. That single shift in thinking separates the professional trader from the person who gambles out of emotional need. The market never promises anything. The moment you begin expecting certainty, you create emotional pain. Too many people approach markets searching for guarantees. They want a formula that tells them tomorrow's outcome with accuracy. But markets reflect the fluidity of human emotion, not fixed rules. Your job is to position yourself where the probabilities align. Think about it. Every movement in price represents a collective expression of fear, greed, confidence, and hesitation. How could anyone expect absolute prediction in such an environment? What you can do is recognize recurring emotional patterns. Markets are complex, but human responses are not. Fear looks the same on charts again and again. So does greed. Once you've studied these patterns long enough, you stop predicting and begin assessing probabilities. You start saying, this structure tends to lead to this outcome, instead of insisting this will happen. The amateur wants to be right. The professional wants to operate effectively. I've seen traders sabotage profitable trades because they couldn't tolerate uncertainty. They needed immediate confirmation, and when they didn't get it, they panicked. You cannot force the market to validate your expectations. You can only act based on the information you have, and accept that even the best setups fail. A successful trader doesn't need to be right consistently, only consistently aligned when the odds favor him. Think about how crowds behave after a major move. As price climbs steadily, confidence grows irrationally. People convince themselves the move will never end. Then at the top, where probabilities have shifted, they still can't perceive the change. They are blinded by certainty. Probabilistic thinking protects you from this emotional trap. It keeps you objective. You stop emotionalizing outcomes. You stop needing to be right. You become willing to be wrong because wrong is simply part of the distribution of outcomes. The market speaks in signals, not guarantees. A breakout with strong volume is a signal, evidence that the collective energy supports upward movement, not a promise. A reversal after a long decline is evidence of seller fatigue, not destiny. The trader who understands probability handles these signals like a detective, evidence to be weighed, not prophecy to be believed. The moment you attach certainty to a trade, you attach emotion to it, and emotion distorts perception. That distortion is where traders get punished. Every consistently successful trader I've known accepts uncertainty as an essential part of the game. We don't control outcomes. We control our risk, our position size, and our willingness to step aside when conditions shift. That is the essence of probability-based trading. It's not about predicting, it's about managing your edge. Let me ask you, when was the last time you took a trade knowing it might fail and still felt calm? That psychological balance is what separates professionals from emotional traders. If you've done your analysis, defined your risk, and contextualized the market properly, then a losing trade becomes nothing more than a normal event within a broader statistical framework. One trade is meaningless. What matters is the series. That's how professionals think. They operate through the principle of large numbers, not the outcome of any single moment. When you shift from prediction to probability, you liberate yourself from the emotional weight of needing to win. You begin thinking like someone running a business instead of someone trying to satisfy an emotional craving. Each setup becomes an opportunity with a definable expectation. If I take this trade 10 times under these conditions, will it make money overall? That's how systems are built. Confidence grows from consistency, not from calling tops or bottoms. Remember what we talked about in the video on early signs of a trend. Early signs aren't confirmation. They are indications. They reflect an emerging alignment in collective behavior. That's the essence of probability. You're not claiming to know what will happen. You're identifying what is likely to happen and positioning yourself accordingly. That's the difference between speculation and gambling. Gambling is acting without evidence. Speculation is acting with awareness of uncertainty. The best you can ever do as a trader is stack probabilities in your favor. Maybe your setup wins 60% of the time. That's nowhere near perfect. But with proper risk management, it's enough to generate significant results. The key is ensuring the 40% of losing trades remain manageable. A trader who understands probability doesn't pursue perfection. He pursues consistency. He understands that losses are part of the process, just as temporary setbacks are part of long-term growth. Consider how a casino operates. It doesn't need to win every game. It just needs an edge, even a small one, applied consistently across many trials. That's how a casino makes money. And that's exactly how a trader must think. You build an edge through consistency, self-awareness, and understanding recurring patterns in market behavior. Then you execute that edge repeatedly without letting emotion hijack your process. Over time, probability rewards the trader who shows up with discipline far more than the one who tries to impress the market with brilliance. The dangerous part about certainty is that it seduces you into risking too much. When you convince yourself you know what a move will do, you naturally increase your position size. And when the market expresses something different, you're left exposed. A professional never allows that emotional distortion. He sizes trades based on controlled risk, not on psychological conviction. The market has the power to humble anyone at any moment. And humility is the trader's greatest protection. Confidence belongs in your process. Certainty should never belong in your predictions. Once you truly begin thinking in probabilities, the entire market transforms. You stop asking, will this go up or down? And start asking, given the evidence, which direction has the greater psychological and structural likelihood? You stop reacting impulsively to every price movement and instead focus on setups aligned with your defined plan. It's not about having a supernatural sense of the future. It's about giving the market enough room to reveal clarity. The market rewards patience with opportunity, but it punishes certainty with emotional destruction. Most traders fail not because they lack technical skill, but because they cannot accept the psychological reality of uncertainty. They reach for control in a domain where control doesn't exist. The truth is, the only control you ever have in trading comes from preparation, position sizing, and a probabilistic mindset, never from predicting outcomes. The market moves in its own rhythm, at its own pace, and for its own reasons. All we can do is observe, interpret, and respond. When you accept that uncertainty is permanent, it stops being a threat and becomes part of the environment you work within. Strength or weakness often reveals itself not through headlines, but through how prices behave after news hits. Most traders learn this too late. The market doesn't move because of the news, it moves because of the collective emotional interpretation of that news. Headlines blast updates on earnings, interest rates, geopolitical events, and economic reports. But price, the actual movement of the market, tells you something far more valuable: how the participants feel about that information. And those feelings, not the news itself, direct the market. News by itself is neutral. It's just information. But the way price responds to that information reveals the underlying structure of belief. If bad news hits and the market barely declines, that's not random. That's strength. It shows that selling pressure has weakened and that confident participants are absorbing whatever fearful traders are dumping. On the other hand, if great news comes out and prices barely rise, or worse, reverse, that's weakness. That's distribution happening quietly, while the crowd still celebrates the headline. This is a lesson I saw unfold repeatedly in my early trading years. I used to believe that keeping up with every report would give me an edge. I studied every update, every earnings release, every economic announcement, thinking I'd be ahead of the curve. What I didn't understand was that by the time the news reached me, the market had already priced in the expectations of the participants who acted earlier. The professionals trade the expectations. The public trades the reactions. That's why watching price behavior after the news is infinitely more valuable than trying to trade the news itself. Let me ask you, how many times have you watched a company report record profits only to see the stock fall the next day? Or seen a negative report come out, yet the price barely budges? That is the market expressing its real belief system. The price already anticipated the outcome. The smart money positioned itself long before the news broke publicly. By the time the headline appears, the real move is already complete, or in the early stages of reversal. You cannot trade headlines efficiently, but you can absolutely trade the reaction. That's where the probabilistic edge lives. For example, when a market absorbs bad news without further decline, it signals exhaustion in selling pressure. That suggests the downtrend may be nearing its psychological limit. Professionals aren't unloading anymore. They're beginning to accumulate. That's true strength. It's quiet, subtle. You only see it if you train your perception. The opposite is equally revealing. When good news produces weaker and weaker rallies, distribution is underway. Insiders use the public's optimism to unload their remaining positions. Think back to what we discussed in the earlier video on early trend signals. We talked about how the initial clues of a trend often appear not in headlines, but in the way price behaves against expectations. This principle fits perfectly with that. When price starts reacting with resilience to bad news and expanding on good news, early strength is forming. When price ignores good news and collapses on the slightest disappointment, weakness is already taking root beneath the surface. A strong market behaves like a person with inner confidence. It doesn't react dramatically to fear-based noise. It rises steadily, even when doubt is widespread. A weak market behaves like someone anxious. It overreacts to every minor threat and breaks easily under pressure. The key is not predicting what the next news release will be, but observing how the market digests the information already available. Does it climb despite discouraging headlines? That's demand. Does it sell off despite encouraging updates? That's a warning. This works because all news is filtered through human emotion, and the crowd's emotions always trail the actions of professionals. The participants with foresight act early. The public reacts late. And that gap between early action and delayed reaction creates consistent opportunity for traders who observe behavior instead of listening to stories. That's why I always say, don't listen to what the market says, watch what it does. At major bottoms, fear fills the air. Analysts warn of disaster. Investors vow to avoid stocks forever, yet prices begin climbing quietly. That's not an accident. That's strength forming beneath widespread despair. It's professional accumulation, while the public is emotionally immobilized. The same psychology appears at major tops. Optimism fills the environment, forecasts turn euphoric, and yet prices begin struggling to advance. Each piece of good news becomes an exit for the traders who know the move is aging. This is why a trader must separate raw information from psychological interpretation. Price does not lie. Opinions do. When you witness a market rise against negative expectations, you're watching confidence in motion. When you see it fall despite positive expectations, you're watching fragility. The crowd rarely notices these shifts because they're focused on the narrative, not the behavior. But the trader who analyzes reactions instead of headlines remains consistently ahead. Timing matters deeply. The initial reaction to news is often emotional, fear-driven or excitement-driven. The crowd's knee-jerk response rarely carries true informational value. But the second move, the one that forms after emotion fades, reflects real conviction. If after bad news the market recovers and holds the recovery, that's authentic strength. If it collapses after good news and fails to retain gains, weakness still holds control. Always wait for the second expression. That's where clarity lives. Price behavior around news also reveals where confident participants are positioned. For instance, if a stock gaps down on negative news but finishes near the top of its range, that's accumulation. Someone stepped in decisively. But if it gaps up on good news and closes near the lows, that's distribution. Professionals used enthusiasm to sell into demand. These patterns are visible to anyone willing to look without emotional bias. Understanding price reaction to news isn't about dismissing fundamentals. It's about interpreting them through the lens of trader psychology. Fundamentals explain what should happen. Price explains what is happening. When the two diverge, you trust price. The market's unemotional logic stays ahead of every story. When you train yourself to notice these reactions, big moves stop surprising you. You see them forming quietly as the market tests the crowd's emotional threshold. Every exaggerated reaction, every muted response reveals who's asserting control, professionals or the public. And when you can answer that question with confidence, you can position yourself early, long before the headlines catch up. The future of any move is visible in the present price action. Every serious trader eventually learns this truth. You don't need tomorrow's headlines to understand where the market is leaning. You simply need to study the market's behavior right now. Price, volume, structure, pace. These are the footprints of what the future is becoming. The market never shifts direction suddenly. It always leaves psychological clues, small, consistent signals, for those who can perceive them. Every major move begins long before it becomes obvious. The public recognizes it only when it's halfway done, but the trader who has trained himself to read behavior sees the shift forming in real time. When you study price action, you're not looking for guarantees. You're looking for evidence. The market reveals everything, but most traders are too focused on predicting to notice what's already unfolding. They want to jump ahead rather than observe what the market is currently expressing. Price action isn't just lines on a screen. It's a conversation between buyers and the sellers. Every candle, every tick, every surge in volume is a sentence in that conversation. If you learn to listen, you'll sense when pressure is building, when enthusiasm is fading, and when momentum is transitioning. The future move, whether it's a breakout, reversal, or collapse, is always born in those subtle shifts before the crowd detects them. Let me ask you, how often have you seen a market make a sudden move and everyone calls it a surprise? Professionals never find it surprising. They saw the build-up days or weeks in advance. They noticed the higher lows forming quietly, the tightening ranges, the increase in volume without much actual progress, the way bad news stopped producing further declines. These are all psychological footprints of shifting belief beneath the surface. The market always reveals its intent, but it communicates through subtle changes, not dramatic declarations. That's why pure observation is the most valuable trading skill, not complicated analysis, not rigid opinion, pure objective observation. Watch how price behaves. Watch how it responds at key levels. Does it hesitate where it once collapsed easily? Does it push through resistance with commitment? Does volume support or contradict that movement? Every one of these details signals something about the emerging probabilities. The future isn't hidden behind confusion. It's fully visible inside the present moment. You might remember in our earlier discussion about signs that a trend is about to begin. We explored how early patterns reveal the psychological tension building in the market. This concept grows directly out of the same principle. The beginning of any trend doesn't appear from nowhere. It emerges from the internal dynamics already shaping the current price structure. Consolidation, indecision, temporary false breakouts. These are the psychological foundations that precede any major move. The trader who interprets those early changes will always seem lucky to others, but it's not luck. It's alignment with how market psychology transitions. The market, in many ways, behaves like a living psychological system. It contracts, expands, pauses, and breathes. When collective confidence is low, price moves slowly. When conviction grows, the market accelerates. Price action expresses these emotional cycles accurately. For example, before a strong uptrend, you'll often see quiet accumulation, a pattern of higher lows forming, steady volume supporting the base, resistance being challenged repeatedly, and sellers gradually losing conviction. The future uptrend is already forming. Its structure is visible long before the breakout. The same psychological process applies to tops. Distribution doesn't unfold in a single dramatic moment. It happens gradually, in subtle transitions. Prices stop rising on positive news. Volume swells, but progress shrinks. The market begins reacting poorly to strength. The downtrend is invisible to the public at this point, but it's already alive in the present behavior. If you learn to interpret these shifts with emotional neutrality, you stop chasing moves after they've run. Instead, you start positioning yourself before the move reveals itself to the crowd. The future is nothing more than the magnified expression of what's already happening right now. That's why every serious trader keeps his attention anchored to the present, not stuck in hope about the future. The present moment is where the truth lives. The future only displays the consequences of what was already in motion. You've probably noticed how certain markets begin behaving differently before major moves. They don't break out immediately, but their character shifts They stop falling on weak sessions. They begin respecting higher levels. They trade with renewed energy. That's not coincidence. That's accumulation. Large, confident traders stepping in quietly, and price reflecting that subtle change. The same thing occurs before declines. Prices begin feeling heavy. Rallies weaken faster. The market fails to sustain progress. The public calls it confusion. But in reality, it's the early stage of a shift in belief. The future move is being written moment by moment in the present price action. When you truly understand that, your entire trading approach evolves. You stop reacting impulsively and start anticipating, not through guessing, but through reading the psychological structure unfolding in front of you. You become less emotional, less impatient. You wait for confirmation in the behavior of price itself. The market doesn't care what you think should happen. It only reflects what is actually happening. That's why the best traders spend far more time observing than forecasting. The chart is the objective truth teller. Everything else is subjective noise. The beauty of price action is its honesty. Indicators can lag. Opinions can distort perception. But price is immediate. It reflects every belief, every fear, every expectation in real time. When you see a level tested multiple times, that's the market building psychological energy. When volatility shrinks after a prolonged decline, that's emotional exhaustion. When a surge in volume appears after calm, that's renewed attention. Each of these signals points forward, hinting at the emerging shift. The key is interpreting them without emotional bias and acting with disciplined execution. You don't need to predict the future if you can recognize its reflection in the current moment. That's exactly what professionals do. They don't guess. They observe. They wait. They act when the market shows alignment. The future move, whether a rally, reversal, or collapse, always leaves its fingerprints in today's behavior. The higher highs, the failed retests, the weakening reactions, the way volume behaves at critical points. Each of these signals is a message from the future written in the language of price. Most traders overlook these because they want the emotional thrill of prediction. They want to be the first to declare the next big move. But the market doesn't reward the loudest predictions. It rewards the most accurate interpretations. You don't have to see far ahead, just far enough to understand that the next move is already forming in the present. The trader who studies today with clarity always knows more about tomorrow than the trader who guesses blindly. The future doesn't arrive suddenly. It's already here, disguised inside the present moment. The market broadcasts it in every subtle shift, every hesitation, every burst of activity others dismiss as irrelevant noise. Once you understand this, you stop chasing illusions and start trading what's actually occurring. You stop hoping for signals and start recognizing them. You realize the next move, the next opportunity, the next turning point isn't something that will appear later. It's already developing now through the living psychology expressed in price. Quiet accumulation periods always precede explosive trends. That's one of those timeless truths that remains valid across generations. Markets evolve, technology advances, but the underlying human behavior remains the same. Accumulation is simply the expression of patient confidence from those who understand the unfolding structure. It's the calm before the expansion, the silence before the momentum begins. Most traders overlook accumulation because it lacks excitement. But that quiet phase is the foundation of major opportunity. Professionals thrive in calm markets. They build positions while the public loses interest. During accumulation, prices trade in tight ranges. There's no drama, no dramatic headlines, no startling movement. Volume shrinks, Volatility fades, attention disappears. The public becomes bored and looks elsewhere for stimulation. They assume nothing important is happening, but in reality, that quiet phase is where future trends are born.